Hey, I'm Rich Rosso, and welcome to the Lance Roberts podcast. Today, I've got one of my idols, and I'm very excited, Dr. Zvi Bodie. And Dr. Zvi Bodie is the Norman and Adele Barron Professor of Management at Boston University. So he writes about pension finance. He's got great books, but I'll tell you, he's more than that. He is a myth buster. And when I first met him, even though I read a lot of his stuff through the years, I had a chance to meet him at a conference. And it's amazing. All of the things that I thought were true about finance, about stocks, are not safer in the long run. All the things that I learned through experience, he had written about. But this is not mainstream. Okay, there's a difference between popular literature and economic science. And I think, Dr. Bodie, you are the myth buster with this stuff. I don't know how popular you are sometimes with the truth.
I love the moniker Mythbuster. That's better than thought leader.
Thought leader has been used too many times. I think you bust myths that impact, and I say this from my heart, I think you bust myths that impact people's lives. And the more the financial professionals can embrace this, and I know that when you speak sometimes to financial professionals, they probably look at you with their mouths agape like, what is he saying? I don't understand. So,
yeah, some of them are in denial. Let's like that.
Yes. And so I write about you quite a bit in my pieces and reference your work quite a bit. I just met with a client, by the way, who followed some of this, and it's wonderful to see when people have these incomes they cannot outlive to take care of their fixed expenses, and their variable assets are there to take care of inflation or to take care of discretionary needs, and their lives are so much easier. They're not worried about the headwinds or tailwinds of market cycles. And what I wanted to talk a little bit about was your elements of life cycle investing. And I know there are 10 elements that you talk about, but I thought maybe you can give us an idea of why these elements are important to people who are listening today and how they start off overall.
Yeah, well, the key idea, this is just recently I was rereading some of the work of Abraham Maslow, his hierarchy of need.
The hierarchy, yes.
And I think that's kind of a useful way to think about, let's call it hedging and insuring, risk management.
So the one thing I know about you, Professor Bodie, is you're very, very passionate about I bonds. And you were talking a little bit about needs versus wants. And is the premise here, and I want you to explain to the audience what the I bonds are, but is the premise here is that your needs are covered, or what you think you're going to need, of course, all the most important necessities are covered with guaranteed cash flows or incomes that are inflation adjusted? Is that where you're going with this?
Well, that's what I recommend doing.
Okay.
Yes. The answer is, yeah, you want inflation-protected, guaranteed income to cover what you consider needs. That's, the way I approach it. And that's not diversifying. That's, in a sense, the opposite of diversifying. It's hedging. And there are various ways of doing that. So, for example, if the goal is retirement, you can postpone your retirement age from, say, 65 to 70.
Mm-hmm.
And as a result of that, your benefit that you get from Social Security will be increased 8% roughly per year. So that is inflation protected income.
So, I mean, the premise you're sharing right now is the fact that since Social Security is sort of become America's pension, even though it was not designed to be, and this is what we help clients to do, is to maximize those benefits because of that 8% delay retirement credit and also survivor benefits. But you consider that hedging.
That is hedging.
Correct.
Absolutely. Because, what you have is needs, spending needs, and you are hedging them by, essentially investing in additional Social Security benefits.
So when you talk about this and your elements of life cycle investing, you talk about hedging, you talk about insuring, and you talk about diversifying. What I find interesting, because I want you to define insuring for me, but what you say, because we say this all the time, is that the popular literature talks about the only way to manage risk is diversification. And we argue all the time that if you're diversifying across stocks, they are highly correlated. And in a down market, you're going to suffer the brunt of it. Now, ketchup might run different than oil, as we say, but it's still headed in the wrong direction. A client's definition of diversification and a broker's definition of diversification rarely meet. And that's why I wanted to share a little about what hedging is, which is what you said, but then you have insuring. And then
Yes. Insuring,
tell me what that is.
Insuring is different from hedging in the following sense. With hedging, you are locking in a certain inflation-protected level of benefits. Mm-hmm. And again, let's say that the goal here is retirement. Mm-hmm. So you're locking in a level of benefits, and you're not going to get any upside. So you have eliminated the downside by giving up the prospect of gain.
Right.
Above, right?
Right.
That doesn't cost you. You don't have to pay a premium for that. Insurance is when you want to retain the upside, but eliminate the downside.
So, Dr. Bodie, when you talked about insuring and you talked about put options, I know that's what you're talking about, is where you can gain upside but limit downside. Would you place in this insuring component, would you put in there, say, for example, fixed indexed annuities or any kind of an annuity structure in that insurance element?
Yes, that is a good example. Or another example would be market index CDs.
Got it. So I'm building, it almost sounds like I'm building these pillars, right? I have my hedging pillar and I've got my insuring pillar. And then you talk about diversification. And I think your definition of diversification differs very, very dramatically from mainstream finance. And I want you to spend a little time on that if you can.
Yeah. So diversification comes in to the issue of, do you want to invest in a single stock or, a limited number of stocks, or a diversified portfolio, say an S&P 500 index fund, or even a more broadly diversified portfolio. So in getting your exposure to the market, unless you have inside information or a strong belief that a particular industry group or individual stock is going to do really well, what you want to do is invest in a diversified portfolio of equities. Or you might include real estate in that. Mm-hmm. In other words, the risky part of your portfolio should be well diversified.
Okay, and we're going to...
Unless you think you can beat the market,
Yeah, which is not usually realistic. But, hey, I want to touch base with you on this on the next segment. And, hey, this is the Lance Roberts podcast with a very special guest, Dr. Zvi Bodie, who's been spending some time with us. And stay tuned.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.